Let's talk about hedge funds. You've heard of them, right? Maybe you've seen a bunch of people on Wall Street wearing suits that cost more than your rent, saying, "My hedge fund made 10% last quarter." And you're sitting there thinking, what the is a hedge fund? Don't worry, it's not just you. Most people have no idea what a hedge fund is. So let's break it down. First, let's get the basics out of the way. A hedge fund is a fancy investment vehicle. It's basically a pool of money from rich people all thrown together and managed by some super smart, or at least super confident, people who make risky bets with that money. They're not like mutual funds where anyone can throw in a few bucks and hope for the best. No, hedge funds are exclusive. If you're not a millionaire, you're probably not going to get in. But if you are a millionaire, well, congratulations. You can throw your money into the mix and hope you get more back. So how do hedge funds work? Well, here's the fun part. Hedge funds don't play it safe. No. They're all about taking huge risks. In fact, they're all about risk. They might bet on things going up, things going down, or honestly, things that have absolutely nothing to do with the market. They'll use every trick in the book, sometimes even borrowing money from someone else to make bigger bets, all while hoping to make more money for you, the investor. And of course, for themselves. Because let's be real, the people running these funds aren't exactly doing it out of the kindness of their hearts. They want their cut. A hedge fund, in simple terms, is a private investment pool. But here's the kicker, to get into one, you need to be rich. Like, seriously rich. You have to be what's called an accredited investor. This means you have to have at least $1 million in assets, excluding your house, or you need to make at least $200,000 a year. So unless you've got a few zeros on your paycheck or a secret stash of cash under your mattress, hedge funds aren't for you. Once you're in though, you get to throw your money into this big pot. And someone, usually a really sharp-dressed guy who looks like he's always about to close a deal, will use that money to make big, risky bets in the market. The goal? To make a return that's higher than what you'd get from the stock market or any regular mutual fund. They're looking for that big win, the kind of win that turns $1 million into $10 million. And if they fail, well, they fail big. But let's not sugarcoat it. This is not the stock market game you're familiar with. This is the place where guys are playing financial chess while the rest of us are stuck with our tic-tac-toe board. You know, it's like playing Monopoly but with $100 bills, and you're not allowed to pass go. Your money is the pawn in a game of who can make the most risky bets with your funds. Alright, let's talk about the name hedge fund. Doesn't sound too dangerous, does it? Sounds almost like something cozy and safe. Like it's there to hedge against risk. You know, a little financial security blanket. But funny thing, it's not really about hedging at all. Originally, hedge funds were designed to hedge against market risk. In other words, the idea was to protect your investments by making bets that some things would go up and others would go down. Kind of like having one foot in a life raft and another on a sinking ship. If one goes down, you're still good. But here's the twist. Over time, hedge funds have transformed into high-risk, high-reward roller coasters. So while the name still has that safe vibe, hedge funds are anything but. Instead of playing it safe, hedge fund managers get really excited about using leverage. Now, leverage is just a fancy way of saying they borrow money to make bigger bets. So instead of putting in just their own $1 million, a hedge fund manager might borrow $10 million, gambling that the market's going to go up. If they're right, they hit the jackpot. But if they're wrong, well, they're suddenly $10 million in debt and probably living in a much smaller house than they had planned. It's like playing poker with someone else's chips. You can win big, sure, but you can also lose big. And trust me, these guys are betting big. And yeah, some hedge funds still hedge against market movements, but most of the time, they're just hedging against their own mistakes. Kind of like how you keep your emergency exit strategy in mind when you get into a bad relationship. Okay, you're probably sitting there thinking, alright, so how exactly do these hedge funds make their money? What's the secret sauce? Well, buckle up, because it's not as straightforward as you might think. Hedge funds, to put it simply, love to play the field. They're not the type to just sit back and hope things work out. Nope. They're active managers, always buying, selling, and adjusting their positions. Imagine trying to make a pizza and constantly rearranging the toppings every 10 minutes. That's kind of what they do in the market. They might bet that a company's stock is going to shoot up like a rocket, or they might bet it's going to crash faster than you can say recession. Sometimes they're using all sorts of mind-boggling financial tools like options, futures, and other crazy stuff that makes no sense to the average person. And don't even get me started on short selling. Basically, they're betting that a stock is going to tank, which, spoiler alert, can really mess with the stock market. Think of hedge fund managers like sharks in the ocean. They're circling around, constantly looking for the next big meal. But these sharks, they don't just want any fish, they're after the big ones. They want the biggest, juiciest gains they can get. They're not here for small wins. They want the flashy, massive payoffs that will make headlines. Now, I know what you're thinking. Wow, this sounds great. But are hedge funds perfect? Do they always win? And the answer is, well, no. Some hedge funds crash and burn so spectacularly that you'd think the managers were just making bets at random. But here's the kicker. If a hedge fund blows up and loses all your money, guess what? The manager still gets paid. That's right. Even if your portfolio is looking as sad as an empty wallet, the hedge fund manager will still walk away with a fat paycheck. How? Well, hedge funds usually charge two types of fees. A management fee, which is usually about 2%, and a performance fee, which can be around 20%. So let's say you throw $10 million at them. They'll take $200,000 just for managing the money, no matter how your investment is doing. Then, if they make you a profit, let's say $1 million, they take 20% of that too. So that's another $200,000 in their pocket. And here's the cherry on top. Even if they lose all your money, they still get that management fee. It's like paying someone to crash your car, and then they send you an invoice for the pleasure. Nice, right? Let's figure out why hedge funds are so exclusive. Why is it that only the wealthy get to participate in this high-risk game? The answer is pretty straightforward. Hedge funds are just too risky for most people to handle. Really, really risky. They're not just investing in your typical stocks and bonds. They're betting on things like oil prices, entire countries' economies, or even currency exchange rates. It's stuff that most regular investors would look at and say, yeah, no thanks. I'm good with my 401k. Because of that risk, hedge funds are only open to what they call accredited investors. If you don't have a couple $1 million in assets or a fancy income coming in, sorry, you're not getting a seat at this table. Why? Because they don't want regular people losing their savings. If their big gamble goes south, they don't want to be the ones on the hook for your life savings. So they stick to the wealthy folks who can afford to lose it all. It's a classic case of you can't play unless you've got the chip. Hedge funds are essentially a VIP club, and if your wallet isn't fat enough to make it through the door, you're not getting in. Think of it like trying to play blackjack in a high rollers casino where the minimum bet is $10,000. If you're sitting there with your $100 and hoping for a miracle, forget about it. You're not even getting a seat. It's not because they're secretly plotting to take over the world, though honestly, at this point, who knows? It's just that the game they're playing is dangerous, and they don't want to risk bringing in people who can't afford to lose. Alright, let's dive into the part that nobody really talks about. The ugly truth behind hedge funds. It's not all champagne and private jets, despite what some people might want you to think. In reality, hedge funds are risky. Like, really risky. And guess what? They don't even always win. In fact, a lot of research has shown that, on average, hedge funds actually underperform compared to simple, low-cost stock index funds. You know, the ones you probably have in your retirement account, which require almost zero effort. Hedge funds charge these insane fees, like the kind that would make a 5-star restaurant look cheap. Yet, despite that, they often don't give you returns that are any better than a basic ETF. And these aren't small fees we're talking about here. They're usually a 2% management fee and 20% of any profits they make. Which seems fair, right? Except when you realize that after all those fees, the hedge fund might still be underperforming compared to a simple index fund. The math doesn't really add up. Now, when hedge funds fail, it's not like losing a couple bucks in Vegas. We're talking about massive, world-shaking disasters. Think of it like watching a building collapse. But instead of rubble, it's your money scattered everywhere. A hedge fund can go down in flames so spectacularly that it makes headlines for weeks. And when it crashes, you don't just lose your Starbucks gift card, your entire investment vanishes. Poof, gone. It's like the money just evaporates, and you're left standing there wondering how you ended up in this mess. And here's the cherry on top. Even when a hedge fund goes belly up, the managers don't lose their fancy suits or their luxury cars. No. They still get paid. They walk away with their mansion, their designer whiskey, and probably a new yacht to cry into. Meanwhile, you, the investor, are left to clean up the wreckage and hope that your next financial move won't be another disaster. So, yeah, hedge funds are a real risky game. They're not for the faint of heart, and despite all the glamour, it's not all luxury yachts and super fast cars. Most people would be better off keeping their money in a simple, low-cost ETF and avoiding the chaos of the hedge fund world. But hey, if you want to throw your money into the fire for a chance for a big win, be my guest. Just don't say I didn't warn you. Alright, let's rewind to 2008, the financial crisis, basically the train wreck of financial history. And who was at the wheel? Yep, hedge funds. These guys were all in on the housing market. They saw the bubble growing, and instead of being the nervous wrecks sitting on the sidelines like the rest of us, they dove right in, betting against the market. When that bubble finally popped, they made a killing. Meanwhile, the rest of us? We were left to pick up the shattered pieces of the economy, trying to make sense of why our 401ks looked more like 101ks. Now, hedge funds weren't just watching from the sidelines. They were throwing gasoline on the fire. Sure, they were betting against the housing market, but they were also heavily invested in those sketchy subprime mortgages. You know, the kind of loans that were about as solid as a wet paper towel. They bet that these bad mortgages would keep going up in value. And guess what? Surprise! When the whole thing crumbled, it was like a financial apocalypse. People lost homes, jobs, and savings. Basically everything they'd worked for. But the hedge funds? They were sitting pretty, raking in profits like they were playing Monopoly. Hedge funds don't just weather the storm, they thrive in it. They're like that one guy at the party who secretly hopes the power goes out so he can save the day by finding a flashlight. It's kind of their whole shtick. Make risky bets, profit from chaos, and when things blow up, they walk away with their pockets full, while the rest of us are left scrambling. So you're probably sitting there thinking, why should I care about hedge funds? I'm not some millionaire making big moves in the stock market. Fair enough. You're probably not about to kick back on a private island anytime soon, unless you've hit the jackpot. If that's you, congrats. And seriously, share your secret. But here's the deal. Hedge funds are making waves that can affect everyone, even if you're not directly involved. These guys are the big players in the market. They're constantly making bets that can change stock prices, make companies rise or fall, and sometimes even cause entire markets to collapse. And the kicker? You don't need to know every single thing about how a hedge fund works to feel the impact. Whether it's the money you've got tucked away in your retirement fund, or the price of your daily coffee, hedge funds are stirring things up, and it can hit your wallet. Let's face it, unless you've got a few million lying around, you're not starting your own hedge fund anytime soon. But that doesn't mean there's some distant, far-off concept that doesn't affect you. These funds are out there, making moves, and even if you're not in the game, you're still feeling the results. You might not be playing their high-stakes game, but you're still riding the waves they create. So what's the takeaway here? Simple. Hedge funds are like that one coworker who's always talking about making big moves, but you're never really sure what that even means. Just nod, smile, and go about your day. While they're out there chasing billions, you're quietly building your own financial future. And honestly, you're probably doing better than the guy losing everything in the process. Next time someone mentions a hedge fund, just nod. You don't need to understand all the details to know it's another odd corner of the financial world, and you're probably better off not getting involved.